Hello traders, Gary Wagner here, just about 1 o'clock in Honolulu, 7 o'clock in New York. It is Wednesday, 30th day of September 2020, and this is the Daily Report for Gold and Silver. We have seen a wild roller coaster ride over the last 24 hours, beginning with the presidential debate yesterday, which I believe was more like a MMA bout. They were certainly not civilized to each other, and they spent very little time talking about details as to their vision of the country, and so it put a lot of people in limbo. We saw equities take off today, but that was primarily due to the optimism that they're going to pass some sort of stimulus bill. However, it did not affect gold, and that is perplexing. Let's take a look at current pricing. Traders, after last night's first presidential debate, we saw gold trade in wild price swings, although in a very narrow range. In fact, the market started selling off as the debate started and carried on throughout the night. We saw gold trade to a low of 1885.80 and a high of 1908. Market closed at 1890.90, down $12.30. We are long from 1890. When we look at silver, silver lost about 4.5%, 23.34. The low on the day, 23.23, and the high, 24.50, down about $1.05. When we look at GLD, we got in at 178 and change. It's at 177, so down about $1 per share. SLV gave up about 3.82%, 21.64 per share. And lastly, we can put the dollar in the unchanged column with the US dollar index currently fixed at 93.92. This first chart is a weekly line chart with the dollar index on the bottom and gold futures on the top. What we can definitely see is that inverse correlation. In other words, when we see the dollar move down, we typically see gold move up. You can see how it peaked at the bottom here and peaked at the top in gold. You can also see this last hook with the dollar moving lower right here and gold moving higher. That, of course, isn't a reflection of today's trading activity, but rather the week. Although we have seen gold trade in a choppy manner over the last week, with the last day definitely having a bias to the downside, I still remain extremely bullish on a technical basis. And the rationale behind it is as follows. We identified a pennant formation. We talked about the fact that as it hits the apex, there will be a tremendous release of energy. While I was 100% correct in that assumption, I was 180 degrees incorrect in terms of the direction that we would see the market break, because it certainly broke to the downside. But what that actually did for us is it showed us a V recovery that occurred right at the 38.6% retracement, as well as the 100-day moving average. And as we spoke about over the last couple of days, when you have two different technical indicators coming to the same conclusion in terms of a price point, we call that confluence, and it gives more credibility or strength to either of those technical indicators when found by themselves. Really nice support at approximately 1850 tells me that we have weathered a short correction here and should be moving to higher pricing. Yesterday, we talked about the different areas we believe we could find some potential resistance, although we haven't even hit those areas so that we can determine whether or not that assumption is right or wrong. The first price point is 1919 to 1920. That is the former record high, which occurred in the middle of 2011. When gold pricing went above $1,900 an ounce for the first time in history. And as we have spoken about on multiple occasions, support and resistance areas can occur at exactly the same price point. It's kind of like being on the second floor and looking up, or being on the third floor looking down. What I really like about what we've witnessed is the fact that we have a defined and strong support level at 1850. We can see that occurrence coming in over the last 3 trading days, and I believe that we will see a recovery that takes us to approximately 1920 to 1941. That is my initial target. Traders, maintain your current long position in gold, either Forex or futures. Unquestionably, the downside move in silver today was much larger in terms of a percentage drawdown than gold. 23.45 is the current print. When we look at a daily candle, you can see that that actually is an engulfing bearish, a 2-day candlestick pattern. However, this is occurring just above a key level, $23, which is the 38% retracement. Very similar to what we saw in gold. If you see the lows that came in 5 trading days ago, they came just to but not below the 100-day moving average. And it is for that reason that I think what we're witnessing both in gold and silver is a fairly dynamic V recovery. Maintain your current long position in silver. And traders, just like we look at equities, when it comes to the ETFs GLD and SLV, I like to smooth the chart out by looking at a weekly chart. And that's exactly what we have on the screen. We can see that we traded to a low today of approximately $175 per share. We got a recovery, $177.12, just under $1 per share from our entry price. Maintain your current ETF in GLD. And lastly, we're going to look at SLV. We're also going to look at a weekly chart, and we can see that the move was so much more exaggerated and magnified when we consider what occurred last week. That's this large candle here. We do have a small gap. Gaps typically are filled, but you can see that silver in essence had a parabolic rise from about $11 up to $27. And if we mark any kind of significant recovery, I do expect it to once again challenge $30. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Thursday for the next daily update and review. Bye-bye.